The next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. What it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risks. Stocks are coming down. Then interest rates are going to come down too.
The Federal Reserve is poised to leave its key interest rate unchanged Wednesday when the Fed faces an economy that has proved resilient but is under pressure from surging interest rates, overseas turmoil, and anxious investors. Federal Reserve Chairman Jerome Powell acknowledged recent signs of cooling inflation, but said Thursday that the central bank would be resolute in its commitment to its 2% mandate. In a widely anticipated speech delivered to the Economic Club of New York, Powell evaded committing to a specific policy path, but did not indicate that he was leaning toward a push higher for interest rates. According to economist Jim Rickards, interest rates have likely peaked and are expected to decrease. In the bond market, when interest rates decrease, bond prices tend to rise, but the extent of the price increase varies with the bond's maturity. Longer maturity bonds, such as the 10-year note, tend to experience more significant price fluctuations, making them more volatile in response to interest rate movements. This relationship is due to bond price sensitivity to interest rate changes, known as the dollar value of 1 basis point, DV01. Longer-term bonds tend to be more volatile in response to interest rate movements. Since late July, the yield or rate on the 10-year U.S. Treasury note has jumped from around 4% to about 4.8%, a 16-year high. The run-up in the yield has inflated other borrowing costs and raised the national average 30-year mortgage rate to 7.5%, according to Freddie Mac, a 23-year high. Jim sees that among U.S. Treasury securities, the highest yields are found in shorter-term securities, particularly 6-month bills. This is unusual, as longer maturity bonds typically offer higher yields to compensate for the added risks associated with a longer investment horizon. In the current market, 2-year notes provide a high yield, but with less volatility than 10-year notes. This makes 2-year notes an attractive option for investors looking for safety and a decent return. We will now present clips from Jim Rickards' interview with Paradigm Press. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. From 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes. And the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all Treasury securities. But so I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may do very poorly if a company's going to underperform. We're going to go into a recession. We're going to have you're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. But so we're talking about U.S. Treasuries. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but well, between 5.25% and 5.5% for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to lose, you're going to have a capital loss. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back, but from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. So again, 10-year note is riskier. From a market point of view, not risky from a credit point of view, good yield, and a lot of capital gains potential.
Official data released on Monday revealed that gross domestic product, GDP, expanded by 4.94% in the third quarter compared to a year ago, falling short of the 5% median estimate from analysts surveyed by Bloomberg. Furthermore, the economy exhibited a modest growth rate of 1.6% in the previous 3 months, also slightly below the survey's estimated 1.67%. Jim, an expert in economic analysis, foresees that the United States might be heading into a recession despite the recent surge in GDP growth, reaching 5% in the third quarter of 2023. He emphasizes that this growth heavily relied on consumption and inventory buildup, with the understanding that increased consumption contributes to GDP, just as inventory buildup does. However, an important factor to consider is the fate of this inventory. If it remains unsold, it ultimately leads to markdowns and sales aimed at clearing the excess stock, often prompting retailers to offer discounts and bundling promotions to attract buyers. The inventory situation is closely tied to consumer behavior. Notably, in August, consumer spending suddenly slowed down, possibly due to the reduction in government-issued pandemic stimulus checks. In 2020 and 2021, Trump and Biden implemented stimulus checks totaling $1,400 and $600 alongside other relief measures. However, by 2023, savings were depleted, and the savings rate fell from 13% to 3%. Many resorted to credit cards, accumulating high-interest debt. Jim Rickards sees this credit card reliance as a potential factor in an upcoming recession. Let's get back to the interview.
The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, but people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff. But if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise, and particularly in certain areas, stuff goes out of style. And the fashion industry is notorious. Who wants last year's, coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they'd done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were we were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%.
In the near future, it's expected that the Federal Reserve will maintain its current interest rate, emphasizing its commitment to a robust economy amid rising interest rates and global uncertainties. What are your thoughts on the interview? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.
So, okay, right now we're in kind of rally mode. Why is it rallying? Well, interest rates are going down. This started in kind of mid to late October. The Fed signaled that maybe they're done raising interest rates, and maybe they are. And we'll talk more about that as we get closer to the December meeting. So, if interest rates go down, stocks go up. That's the narrative. Wall Street always has a narrative for you. Goldilocks, soft landing. There's no such thing as a soft landing, by the way. There are hard landings, there are crashes, and there are booms, but there's no such thing as a soft landing. If you're going down, you're going down.
In September, the Federal Reserve maintained its benchmark interest rate for the second time in 3 meetings, signaling a shift in its anti-inflation strategy, reflecting a more measured approach as inflationary pressures ease. This decision was accompanied by the Fed's hint at a solitary rate increase for the year and a projection of a continuous rise in the key rate until 2024, exceeding previous forecasts. As the Fed prepares to reduce its key interest rate, the initial pace is expected to be gradual, ruling out a swift return to ultra-low rates. The year-over-year rate of price increases barely surpassed the Federal Reserve's target, standing at 3.2% in October, according to the Bureau of Labor Statistics. Investors interpreted this as a sign of an end to monetary tightening, drastically reducing the odds of a rate hike at the Fed's meeting. However, despite this cooling, unemployment rates remained near historic lows in October, and economic growth recorded its fastest rate since late 2021 in the third quarter. Yet public sentiment remains cautious as inflation expectations rose to 4.2% in October from the previous month's 3.2%. Concurrently, Jim Rickards attributes the current market rally's momentum to declining interest rates since late October. This shift was prompted by the Federal Reserve's indication of a potential halt in rate hikes. Contrary to prevailing narratives like Goldilocks scenarios or soft landings, Jim suggests these ideals diverge from harsh economic realities. He contends that economic downturns tend to be abrupt rather than gentle, challenging these optimistic narratives. Anticipating a potential downturn in the stock market, Jim foresees forthcoming data, likely by year's end or early next year, strongly indicating an economic downturn, potentially leading to a substantial contraction in the stock market. Despite warning signs, prevailing sentiment on Wall Street continues to align with the Goldilocks narrative, highlighting the disconnect between popular belief and economic realities. While the market hasn't peaked yet, Jim forewarns a possible significant downturn, possibly ranging from 30% to 50%, reminiscent of historical recessions' market crashes. We will present clips from Jim Rickards' interview with Paradigm Press. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
So that's why stocks are rallying right now, because interest rates are coming down. But what people don't stop to ask is, okay, interesting, why are interest rates coming down? Could it be we're in a recession? Could it be we're seeing disinflation, maybe even deflation? Could it be industrial production is down, which it was? That was reported the other day. Initial claims are up. That was reported the other day. Unemployment ticked up a little bit, not huge, but in the last employment report at the beginning of November. This is in addition to the more technical signs. I don't want to get too far in the weeds in terms of inverted yield curves and negative swap spreads and a lot else. Those are long-term or long-range indicators of recession. We've been talking about those for a year. They're very powerful indicators, but they don't tell you the exact timing. But the other items I mentioned, things like industrial production and so forth, are much more real-time, and they're all turning negative. So I would expect the stock market to turn around and kind of go down significantly between now and the end of the year, early next year, certainly, because by then the data will be undeniable. Right now, again, the Wall Street Goldilocks soft landing scenario prevails. It doesn't mean it's right. It just means that that's what people believe. But Wall Street, again, they're just trying to sell you stocks. They'll sell you stocks right up until the day it crashes. I'm actually writing one of our newsletters. I'm writing it today, and I went back and looked at the recessions in 1974 and 1981. And the Dow Jones in 1974 recession, the Dow Jones fell 45%. In today's level, that would be the equivalent of 15,000 Dow points, slightly more. So wow. Imagine the Dow Jones down 15,000 points. That's a 45% decline from today's level, and that's what happened in 1974. It's not ancient history. What caused it? Well, it was the a war in the Middle East and Arab oil embargo and higher oil prices. Sound familiar? I mean, that's kind of what we're going through right now. We're going back to 2021 with the supply shock. And then in 1982, 81, 82, that recession, the NASDAQ fell 38%. So, peak to trough. So that's what a real recession looks like. And that's what a stock market crash looks like. And so we could be heading for something like that. But, it peaks when it peaks. But by the way, it peaked 2 years ago. So we're not even at the peak. But yeah, it could go down 30, 40%, maybe 50% from here.
The U.S. stock market began the week with a decline, led by a sell-off in technology shares. The Dow Jones Industrial Average experienced a decrease of 144 points, representing a 0.4% drop, while the S&P 500 and NASDAQ Composite faced more significant decreases of 0.9% and 1.1%, respectively. This reversal contrasts sharply with the recent upward trajectory in these indices, with the S&P 500 reaching its highest closing point since March 2022 last Friday, and the Dow achieving its first 5-week winning streak since 2021. Jim's perspective sheds light on a longer-term view of the market, emphasizing that despite recent intermittent rallies, Major indices like the S&P 500, Dow Jones Industrial Average, and NASDAQ 100 have been on a consistent downward path for over 2 years, dating back to late 2021 and early 2022. While acknowledging the profitability potential within these intermittent rallies, Jim urges caution against excessive enthusiasm tied to these short-lived market fluctuations. He underscores the inherent volatility within the market, characterized by frequent fluctuations, emphasizing that despite these short-term peaks, the overarching trend remains firmly on a downward trajectory. This perspective serves as a reminder of the market's inherent unpredictability and the importance of considering long-term trends amidst short-term market excitement. Let's get back to the interview.
The S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100 all peaked in late 21 and January 2022. Look at a 3-year chart. Stop looking at a 3-day chart. I don't mean you, I mean just people in general. Stop looking at 3-day charts. Look at a 3-year chart. They all peaked. NASDAQ peaked in November 2021, and Dow Jones and S&P peaked in January, like the first week of January 2022. Those indices are down significantly from where they were almost 2 years ago or over 2 years ago. So you can talk about the bull market all you want. They're down over the last 2 years, period. Now, has there been a rally lately? Yeah, and there have been 4 or 5 along the way. And I'm not saying you can't make money, but I'm saying that in this volatility, up and down, the trend is down. So let's not get too excited about the stock market because the trend is down, as I described. Just look at a 3-year chart. You'll see exactly what I'm talking about. Now, where do we go from here? Oh, stock markets are bubbly in the face of something horrible. Where we've seen that before. I mean, the stock market during the cycle around the 2007-2008 financial crisis. Remember, that crisis started in the spring of 2007. It kind of reached a fever pitch in August 2007. That was when Jim Cramer had that famous meltdown with Aaron Burnett on CNBC. They know nothing, et cetera. But the stock market actually peaked in October 2007. So there we are 6 months after HSBC warned about rising defaults in mortgages, 2 months after the Fed almost caused a meltdown. Jim Cramer called them out in August 2007. But the stock market peaked in October 2007. So stock markets go their own way. They're supposed to be leading indicators. They're really not. So first of all, the stock market is not peaking. The peak was 2 years ago. Right. And the peak is exactly when I said kind of November 15, 2021. So that's more than 2 years ago. And it still has not regained that peak. So that's the reality. Now, you're right, Matt, there's some rallies, but there's some big dips along the way if you look at that. Okay, right now we're in kind of rally mode. Why is it rallying? Well, interest rates are going down.
Economists predict the U.S. Federal Reserve will keep interest rates unchanged until at least July, focusing initially on adjusting the real interest rate rather than implementing stimulus measures. This forecast contrasts with Chair Jerome Powell's recent statement affirming that policymakers are prepared to tighten policy further if it becomes appropriate. How might the Federal Reserve's approach to interest rates and inflation impact the market? Especially given Jim Rickards' contrasting view on the current rally? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.
We're in a period of disinflation, bordering on deflation. We've just come through a period of inflation, for sure. 9.1% in June 2022.
Our euflation, follow it closely, trailing 12 months, 1.88%. The Fed will get to its 2% target and actually go below that. And then we could, God knows what we're going to, but what the progressives could bring in terms of central bank digital currency and universal basic income and modern monetary theory, the whole thing. We could have rip-roaring inflation. It should not an interim trade right now.
I think we're just entering a more multipolar world rather than a world where every country just kind of unanimously uses dollars and doesn't really think twice about it.
The significant increase in the base money supply from $800 billion in 2008 to nearly $10 trillion in 2020 didn't lead to notable inflation. This illustrates that inflation isn't solely tied to the money supply. It's also affected by people's spending behaviors and inflation expectations, known as velocity. While an increase in the money supply could cause inflation if combined with heightened velocity and altered expectations, it isn't guaranteed. Despite efforts by the Federal Reserve to manage inflation by controlling the money supply, the complex blend of behavioral factors, disruptions in the supply chain, and various types of inflation necessitate a more nuanced approach than simply adjusting the money supply. According to Jim, the current economic climate is shifting from high inflation to disinflation, potentially even deflation. This change follows a period of substantial inflation, notably in June 2022, primarily attributed to disruptions in the supply chain. Globally, the inflation rate is expected to settle around 9% by the year's end, posing a recurrent challenge for many developing countries. 2022 U.S. consumer prices surged by about 7%, the highest increase in 4 decades. Germany is expected to reach nearly 10% inflation, marking its first instance of double-digit inflation since 1951. This highlights the complexity of inflation, stressing the necessity for a comprehensive strategy beyond solely regulating the money supply. Jim uses indicators like the euro-dollar market and negative swap spreads to assess the economic situation. Swap spreads reveal the difference between the risk-free government bond rate and what a dealer pays on a fixed leg of a swap. Due to banks facing challenges in financing derivative positions, swap spreads are reversed, showing that government rates are lower. This struggle for collateral affects these swap spreads significantly. Moreover, the demand for collateral, especially treasury bills, bolsters the U.S. dollar's strength globally. Jim highlights that exchange rates are more influenced by collateral demand, the state of the euro-dollar market, and supply-demand dynamics rather than traditional factors like interest rate differences. We will present clips from Jim Rickards' interview with Thoughtful Money. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
We're in a period of disinflation, bordering on deflation. We've just come through a period of inflation, for sure. 9.1% in June 2022. But that was supply side driven. That has snuffed itself out. A lot of the logistics problems have been solved. And there's actually less demand. You don't have to worry about logistics if people don't want the stuff. Gasoline is a good example. Gasoline consumption is dropping, but usually demand is pretty inelastic. It's the kind of thing, you need your gasoline. No matter what the price is, you got to go to school or take the kids to school or go to work or whatever. So you buy it anyway, even though the price is pretty uncomfortable. But the usage is actually dropping. That's a very powerful recession sign. There are others looking inside the euro-dollar market. The swap spreads are negative. What's a swap spread? Swap is, I pay a fixed rate and you pay me a floating rate, or vice versa. It's a derivative bond. It's a synthetic bond position. If I own a bond, I finance it overnight. I'm receiving fixed and paying floating. So swap spreads are the difference between the risk-free rate, what can you get if you buy a 5-year note or a 10-year note on the one hand, and what a dealer pays you on the fixed leg of a swap. Now it follows, that could be anywhere, but it follows that the government rate should be lower than the counterpart rate. If I can get if I have a 5-year treasury note that's as safe as you can get, and versus a bank paying me a fixed rate for 5 years, like, okay, good bank, but there's a little risk there. So it follows that the bank rate should be higher than the government rate in the fixed leg of a swap. It's not true today. I mean, the statement is true, but the data is the opposite. The bank is paying a lower rate. So are bank credits suddenly better than government credits? No, not at all. The reason they're lower is because the banks are having difficulty financing derivatives positions because they can't get enough good collateral. Banks can put a swap on without using any balance sheet capacity, whereas if I'm financing a bond, I am using balance sheet capacity. So it's a liquidity preference, and it's a balance sheet preference. It's not lower because of credit. It's lower because of liquidity preferences and the inability to get collateral. And by the way, just to kind of wrap it all up, the demand for collateral, treasury bills in particular, is so great. That's why the dollar is strong. Interest rate differentials, capital controls, all that stuff. I mean, I've studied that since the 1970s. It goes back to the 1950s. A lot of it is obsolete in the world we live in. What does drive what does make the dollar stronger and drive foreign exchange rates is the demand for dollars itself. If I'm Deutsche Bank and I want to buy treasury bills, that's fine. I got to pay for them in dollars, which means I have a demand for dollars. And no one's more desperate than the Chinese. And people, I debate this with my research partners. Like, hey, time to go long the yen. The yen's going back to 135 or whatever. I say, guys, when I started in banking, the yen was 400. So, that's, if you go back not all that far, it's kind of deja vu all over again. But the point is, the Japanese yen is joined at the hip with the Chinese yuan. Because of the extent of Japanese banks are financing everything in China, and they don't want a stronger yen because that's going to hurt their business in China and hurt Chinese exports, et cetera. And so the yen and the yuan are just locked in a de facto peg, and the yuan's going down, so the yen's going down. So look for it to go to 160. But that liquidity, the eurodollar market, and supply and demand, and the demand for collateral, that's what's driving exchange rates, not interest rate differentials. So forget the Bank of Japan and forget the Fed while you're at it.
Lynn Alden's assessment regarding the recent Treasury report reveals Janet Yellen and the Treasury Department's actions to increase Treasury bill issuance. This strategic move aims to bolster liquidity through the reverse repo facility. This surge in bill issuance holds a twofold objective. First, to mitigate the recent spike in the dollar index, and second, to stabilize the upward trajectory of longer-dated yields. By concentrating on infusing more liquidity into the short term, there's a likelihood of a temporary halt in the dollar index's upward trend. However, Lynn cautions that this effect might wane if the Treasury reintroduces a substantial volume of longer-term coupons. On the other hand, Danielle DiMartino Booth holds a perspective regarding the status of the U.S. dollar amid less appealing alternatives. With the U.S. Federal Reserve opting to maintain its benchmark federal funds rate unchanged in its recent policy meeting after 10 consecutive rate hikes, it reaffirms its commitment to bring inflation back to 2% over time gradually. Yet despite the latest Consumer Price Index, CPI report for May, showcasing a cooling annual inflation rate of 4%, which remains well above the Federal Reserve's 2% long-term target, Danielle underscores trueflation. The measure is 1.88% over the last year, close to the Federal Reserve's 2% target. This proximity, and the chance of falling below it, sparks worries about potential deflation, especially in a heavily indebted world. Now, we will present you with clips from Lynn Alden and Danielle DiMartino Booth.
Part of that's going to depend on how much the Treasury focuses on either strengthening or weakening it. We saw from the recent Treasury report that Janet Yellen and the rest of the Treasury are increasing their bill issuance, which allows them to get more liquidity out of the reverse repo facility. I think part of that is to try to arrest the recent rise in the dollar index and arrest the recent rise in longer dated yields to add more liquidity, focusing on the short end. So shorter term, we probably have some pause in the dollar index for a period of time. That could go away as if they were to issue a lot more coupons again. Longer term, I think my overall framework is that we're entering a more multipolar world where we're seeing, this is not exactly news these days, but I've been writing about this for a number of years. It kind of accelerated with the Russian invasion of Ukraine and kind of has cascaded since there. But I think we're seeing a number of powers increasingly focusing on reserve diversification, making their own payment channels. Although, of course, that's a very difficult process. They're up against a very substantial network effect. And this is like a very long-term time frame. So I think we're just entering a more multipolar world rather than a world where every country just kind of unanimously uses dollars and doesn't really think twice about it.
I think there's an interesting phenomena. It's been the deniability around the world of other recessions that are underway. So it wasn't until we saw the Eurozone in its entirety begin to contract that anybody was even begin to pay attention to the fact that Germany has been in recession now for 3 quarters in a row. I mean, they keep revising it downwards, but It is what it is since the fourth quarter of 2022. And when you think about the world's third largest exporting nation, which is what Germany is, and the fact that the world's largest exporting nation is as close to recession as you could possibly have that described by statisticians that our statisticians now make blush. because our data is so ugly and dirty now, it makes Chinese look clean. But when you think about the three largest exporting nations in the world being in recession, then you really don't come out at the other end when you add to that the fact that, everybody keeps saying that the dollar is at risk, and yet they keep pricing their sovereign debt in dollars or corporate debt in dollars worldwide. So that's kind of where you come out at the other end saying at some point, the dollar is going to continue to be the authority that it is on the world stage. On top of that, Truflation, TRU, which I know, Adam, I've spoken to you about before. They gave us the raw data from January of 2012. Jot it down. I know, we all need some more coffee, right? This is New Orleans. But TRU-flation, follow it closely. Trailing 12 months, 1.88%. The Fed will get to its 2% target and actually go below that, which they do not want. There's nothing like having a debt-ridden world with deflation, but that's kind of what's barreling down towards us, meaning the underlying fundamental value of the dollar is not at risk because of inflation, at least until after the election comes and goes, and then God knows what we're going to, but what the progressives could bring in terms of central bank digital currency and universal basic income and modern monetary theory, the whole thing. We could have rip-roaring inflation. It's just not an interim trade right now. I think that right now the prevailing goal is for Powell to be not noticed. He just wants to keep shrinking the balance sheet. So is it anything beyond semantics that with one bad employment report, now we've priced from July to June of 2024 being the first rate cut? I don't think that's relevant in the sense of relativity matters. I don't think we're going to the zero bound anytime soon. I think he's still got decent control of the Federal Open Market Committee and the Federal Reserve Board. I don't think it's a coincidence that the dot plot ends with a 2 handle. Meaning out to 2025, meaning that I don't think he sees, at least as long as he has not, run over by the CIA driving a truck and taken out an election year, I don't think that Powell plans on going back to the zero bound, and I think he's trying desperately to extricate quantitative easing from the toolbox, and the only way that you can do that is to continue shrinking that balance sheet.
Looking ahead, the shift from high inflation to disinflation raises concerns regarding potential deflation. Eurodollar market and swap spreads highlight collateral demand. Higher Treasury bill issuance stabilizes markets amid potential fluctuations due to longer-term coupon returns. How does the inflation shift impact global market stability with collateral demand and increased Treasury bill issuance? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.
This is not the petro yuan. This is not the petro ruble. This is not a gold-backed yuan. This is not a gold standard. This is not the end of the US dollar. It's not the end of the euro. It's not the end of the world. It's not any of those things, but that's what everyone's running around on websites or whatever shouting about. It's none of those things. In fact, quite the opposite. And this is where the Russian mentality comes in. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride by declaring one BRIC equal to a weight of gold. Again, weight's the key.
The BRICS summit in Johannesburg 2 weeks ago was attended by leaders and representatives from more than 60 countries. 6 were officially invited to join the bloc: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. They are set to join the founding members: Brazil, Russia, India, China, and South Africa. And while these countries are vulnerable due to their dependence on the dollar, there is no other game in town. The dollar still dominates global trade and 90% of foreign exchange transactions. Jim Rickards, the author of the national bestseller, Currency Wars: The Making of the Next Global Crisis, clarifies some misconceptions about the role of the BRICS in the global financial system. The BRICS, rather than seeking the downfall of the US dollar, want the dollar to remain strong and for the gold market to thrive. This is because they benefit from the dollar's status as the primary reserve currency. which performs the heavy lifting in the gold market. While the dollar's share of the global currency landscape has declined over the past 2 decades from 66% to 58%, its primary reserve status has not wavered. Rickards emphasizes that the BRICS are free-riding on the existing dollar-based gold system. They don't have to buy or own vast quantities of gold, and their currency isn't redeemable for gold. Instead, they base their currency's value on gold's weight and allow the dollar gold market to go wherever it goes. This strategy enables the BRICS to enjoy the benefits of a gold-backed currency without taking on the complexities and costs of maintaining such a system. We will now bring you clips from Jim Rickards' interview with Wealthian. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The value of the brick is not determined with reference to any other currency. It's determined with reference to gold by weight of gold. Now, and I don't know the weight, they'll pick one, but again, it doesn't matter because it's not even, it's math, it's logic. And by the way, now we're back to Aristotle's transitive law. This is the key. This unlocks the whole thing because Aristotle said, you know, if A equals B equals C, then A equals C. The B can drop out. It's not even arithmetic. It's logic. It's called the transitive law. I'm certain that Aristotle invented it. If any Greek scholars know an earlier source, let me know. So what the BRICS have done is they have dodged the biggest bullet, the thing that caused Bretton Woods ultimately to fail, the thing that potentially stands in the way of all this. They've defined their currency by weight of gold. Now, a weight of gold has a dollar value, right? So A equals B equals C. 1 brick equals 1, could be an ounce or a kilo, it doesn't matter. Call it an ounce. 1 brick equals 1 ounce of gold equals today, 1970, okay? Well, through the transitive law, drop out the B and 1 brick equals 1970, $1,970. But that's constant. I mean, that logic works for a moment in time, but it's not fixed because the price of gold is going to fluctuate daily or minute by minute, right? So what's going to happen is the dollar gold, call it exchange rate, the dollar price of gold. So the LBMA, the COMEX, the London Metals Exchange, JP Morgan, unallocated forward contracts, the whole huge gold market in dollars is still going to exist. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride by declaring 1 brick equal to a weight of gold. Again, weight's the key. They just let the dollar gold market go wherever it goes, and the brick is worth an ounce or whatever, kilo, whatever. And the dollar equivalent under the transitive law changes, but they're not pegged to the dollar. They're not fighting that fight. So this, I analogize this. It's like you're in your house, in the backyard, you know, your landscaper is like digging trenches and putting in plants and sweating and doing all this work. And you're sitting there with a glass of iced tea, enjoying the view. In other words, the BRICS get to free ride on the dollar gold system. And they want that system. They don't want it to go away because they get the benefit of a gold value. Now think of what the BRICS don't have to do in this scenario. They don't have to buy gold. They don't even have to own gold. They do, but no one in the world has enough gold to back a currency. This currency, the brick, will not be redeemable into gold. Now, maybe there's a dealer somewhere who will take it. That's between you and the dealer. But it's not like you're going to be able to march down to the People's Bank of China with a pile of bricks and say, give me the gold. They're not going to do it. So it's not redeemable. They're not going to make a market. They're not going to maintain a value because they don't have to, because it's by weight. They just get to sit back and piggyback on the dollar gold system and let the dollar do all the dirty work.
Rickards emphasizes the role of the Federal Reserve as the ultimate buyer of treasuries, with an intermediate buyer being the U.S. banking system, which has evolved from the 1950s when large banks had a substantial portion of their balance sheets in treasuries. The U.S. government influences these banks and is likely to buy bonds. This intermediate buyer pool could offer a cushion before the Fed expands its balance sheet, especially during a reset, when buying perceived safe treasuries becomes more attractive than making loans. Furthermore, he mentions the Chinese strategy, where commercial banks in China are selling dollars to support the yuan. China's major state-owned banks were seen busy selling U.S. dollars to buy yuan in both onshore and offshore spot foreign exchange markets this week, people with direct knowledge of the matter said, in an attempt to slow the yuan's depreciation. The yuan has lost about 2.4% against the dollar since this month and 6% since the start of the year. The onshore yuan traded at 7.3145 per dollar as of 0442 GMT, while the offshore yuan last fetched 7.3400. Rickards sees that this approach allows the Chinese government to manage its currency strength without excessive reliance on foreign exchange markets. Let's get back to the interview.
The first one is the Fed the ultimate buyer of last resort of Treasury? Yes. But there's an intermediate buyer, which is the U.S. banking system. In the 1950s, a typical large U.S. bank balance sheet was 40% Treasuries. That was normal. That wasn't like hoarding. Today, it's about 5 to 7%. So I think you'll get a phone call to Jamie Dimon and I forget all the other CEOs, Jane Meyer, the lady at Citi. They'll call them first to say, people got to buy bonds. And of course, they're all under the thumb of the U.S. government, and they will. So you might have a pretty good cushion of bond buyers before you have to turn to the Fed and expand the Fed balance sheet. Now, that doesn't
especially if it's a recession, because they're not going to want to make loans with that money. They'd rather buy treasuries that are perceived to be safe. Probably.
Correct, especially with positive carry and lever at 10 to 1 under Basel, you can make very good returns on equity. So, so you do have a large pool of intermediate buyers before you get to the Fed. It doesn't really solve the problem. It just passes it around the banking system. By the way, the Chinese are doing something very similar right now. Everyone's like, why hasn't the People's Bank of China sold more dollars? Well, it's because they're making the banks do it. The commercial banks are selling the dollars and propping up the yuan. And we could see something similar in the United States. So that's one. I just kind of pencil in the commercial banking system, at least the big banks, as potential buyers of not quite last resort, as a way to put it. But the other thing, the BRICS, what they've done, this is part of the brilliance, they've opted out of the exchange market. They're like, because normally if the dollar is getting weaker, you're getting stronger. That's bad for exports. It's bad for export-related jobs, et cetera. You know, and it's currency wars. That was my first book, Currency Wars. But they've, by defining their currency by weight of gold, not dollar amount, but by weight of gold, they're out of the foreign exchange market. Yeah, so, and they can just sit back and watch the show. We haven't learned about uncertainty because we already know about uncertainty. We all understand that we're living in an uncertain world and we have to make allowance for that. So we didn't learn that. We already knew that. I said, well, what is new is the tempo of shocks is accelerating. There are shocks. Go back to the panic of 1837 or 1857 or 1898. You know all of them. I've lived through enough of them. I'm kind of a magnet for trouble. But there's no end to financial panics. But what's different about this is that we may be looking at a tempo that's a lot faster. It's not every 7 years or every 10 years anymore. Between the U.S. is losing the war in Ukraine badly. You might even see Poland come in and bite off the western half of Ukraine, what former Ukraine, up to Lviv, and Russia take the bottom 1/3, including the entire coastline through Odessa, and leave a little landlocked rump state around Kiev, maybe. So and there's no way to cover this stuff up. The New York Times and the Washington Post, I read them the same way I read Pravda during the Cold War. It's all lies, but they're valuable lies because it's good to know what the other guy's lying
exactly about.
Yeah, if he's lying. It's like you must have a reason for that. It must be important to you. So there's intelligence value in lies, and that's why I read the Times and the Post.
Looking ahead, it's likely that the BRICS will continue to pursue their unique approach to the global financial system. Contrary to some expectations, they won't be pushing for the downfall of the U.S. dollar. Instead, they will prefer a strong dollar. What are your thoughts on the BRICS approach to the global financial system? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.